question. Is a small cap fund riskier than a large cap fund? Most people answer, obviously yes, without thinking twice. But that answer depends entirely on one thing most investors never ask. How long are you actually holding it for? Here's what everyone believes. And honestly, it's a reasonable place to start. Large cap companies are bigger, more established, more liquid, so they feel safer. Mid and small cap companies are newer, more volatile, more prone to sharp swings, so they feel riskier. This isn't wrong. It's just incomplete. It's a snapshot of risk taken over a very short window, often just 1 year. And short-term risk and long-term risk are not the same measurement. Treating them as the same is where the confusion starts. Let's break riskier down into something we can actually measure, instead of leaving it as a feeling. In investing, one of the standard tools for measuring how much an investment moves relative to a benchmark like the Nifty 50 is called beta. A beta of 1 means it moves in line with the market. Below 1 means it's less volatile than the market. Above 1 means more volatile. So the natural next step is, what's the beta of a large cap fund versus a mid or small cap fund? And here's where the obviously riskier story starts to get more interesting. Part 1. The 1-year picture. If you look at beta over a short window, say, the last 12 months, mid and small cap segments do tend to show a higher beta than large cap. This matches intuition. Over short stretches, smaller companies can swing harder in both directions, and that shows up clearly in the numbers. If someone is measuring risk purely on a 1-year lens, mid and small cap will look meaningfully more volatile than large cap. That part of the popular belief is genuinely true for that time frame. Part 2. What changes as the holding period stretches out? Here's the part that gets skipped. As you extend the measurement window 2 years, 3 years, 4 years, the beta of mid and small cap segments tends to come down. Not because the companies change, but because short-term noise smooths out over longer periods. Bad quarters and good quarters average each other out. Over a multi-year holding period, mid and small cap beta can end up quite close to, even in the same range as, large caps, rather than dramatically higher. This is a pattern that's shown up in historical, backtested data, and it's worth being upfront. This is illustrative, historical behavior, not a promise about what will happen going forward. Part 3. Why this actually makes sense once you think about the underlying businesses. A mid or small cap company that's genuinely growing needs time for that growth to show up in earnings, and for earnings to show up in price. Over a single year, a piece of unrelated bad news, a sector rotation, or simple market mood can swing the price around in a way that has nothing to do with the business getting worse. Give it 3 or 4 years, and the price has more chance to reflect what the business actually did. So the extra risk that shows up in short-term beta is partly business risk, but a real chunk of it is just short-term noise that a longer holding period naturally filters out. Part 4. The practical implication. Risk isn't a fixed label, it's a function of time horizon. This is the actual takeaway hiding inside all this math. The question, is mid-small cap risky? Is incomplete without the follow-up question, risky over what period? An investor holding for 8 months and an investor holding for 8 years are not exposed to the same risk from the same fund. Calling mid and small cap risky as a blanket label without asking about horizon is measuring the wrong thing for the decision actually being made, which for most long-term investors isn't a 1-year decision at all. Say you're comparing two hypothetical funds, Fund A, large cap, and Fund B, small cap, using illustrative, backtested data. Over a 1-year lens, Fund B might show a beta noticeably above 1, while Fund A sits right around 1. Someone glancing at just that one number would call Fund B clearly riskier, but stretch the same comparison out to a 4-year holding period using historical data, and Fund B's beta often drifts down toward, sometimes even below, Fund A's. Same fund, same underlying companies. The only thing that changed was the length of time being measured. That's the entire point. The label risky moved, the fund didn't. All figures above are illustrative and drawn from historical backtested patterns. Past performance is not indicative of future results, and actual beta figures vary by period and by fund. Before asking, is this risky? Ask yourself, over what time frame am I actually going to hold this? Because for mid and small cap investments, the honest answer to the risk question changes completely depending on that one detail. That's it for this one. If this changed how you think about risk, the next video breaks down another number worth understanding before you judge a fund by its returns alone. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.